Let's just dive right into the data, because we're looking at what might be the absolute most profound macroeconomic paradox in modern financial history. On one hand, you've got this wild AI supercycle and booming capital expenditures, just rocketing markets to historic highs. But on the exact same ledger, we've got fractured global trade lines and severe geopolitical shocks that are literally threatening to tear the bottom right out of the global economy. As you're about to see, there's a huge reason why the world's top financial institutions are completely divided on what happens next.
35%. Now that's not some fringe, worst-case scenario thrown out by a perma-bear. That is JP Morgan Global Research's official, calculated probability of a US and global recession hitting us in 2026. Think about that for a second. We're not talking about a little bump in the road or a temporary dip in corporate earnings here. JP Morgan is issuing a severe, glaring warning. They're saying there's a 1 in 3 chance of a full-blown economic collapse. While the mainstream narrative out there is still desperately clinging to this idea of a soft landing, the underlying data tells a much, much darker story about extreme fragility in the system. I mean, think of it like this. If someone told you there was a 35% chance your house would flood this year, you wouldn't just cross your fingers and hope for the best, right? You'd immediately start moving your valuables to higher ground.
Now, real quick, before we unpack the specific catalyst driving this massive risk, a brief note. Investing entails market volatility risks. This content is just for informational purposes. Past performance does not guarantee future results, and you should, of course, always consider the risks of market volatility before making any investment decisions. Okay, back to the data.
Section 1. Sturdy growth or mirage.
Right now, there is just a sheer, massive contradiction between the top forecasters in the world. Look at Goldman Sachs. They're modeling what they actually call sturdy growth, projecting a 2.8% global GDP expansion driven by tax cuts and easing financial conditions. And the International Monetary Fund? They're even more optimistic, projecting a really resilient 3.1% growth rate. But then, boom, you have JP Morgan over here labeling the whole environment as highly fragile with that 35% recession risk. So what's going on here? How can the absolute smartest people in the room look at the exact same global economy and come to completely opposite conclusions?
Well, it all comes down to the assumptions they're making. The IMF's baseline forecast of 3.1% growth. It's entirely dependent on one massive, glaring assumption. They're assuming that the geopolitical disruptions in the Middle East will be limited in scope and that they'll just, magically fade away by mid-2026. Their super optimistic model literally requires the current global conflict to just disappear. But as we all know, market realities aren't exactly cooperating with that assumption right now.
Section 2. The Strait of Hormuz crisis.
60%. Since the onset of severe hostilities in February 2026, crude oil prices have surged by a staggering 60%. Let that sink in. That isn't just a gentle little uptick at the pump. That is a violent repricing of global energy. The Strait of Hormuz is the primary maritime artery for literally 1/5 of the world's energy trade, and right now, it's been effectively choked off.
With Brent crude spiking well above $100 per barrel, we're witnessing a massive, totally unavoidable inflation tax being levied directly on global households. You know how this goes. When energy costs spike this aggressively, it bleeds into everything. The cost of manufacturing, the cost of transportation, the cost of literally every single item on your grocery store shelf. It just absolutely destroys the purchasing power of the everyday consumer.
And the supply data behind this is absolutely devastating. According to the International Energy Agency, we saw a plunge of 10.1 million barrels per day in global oil supply for March 2026 alone. 10.1 million. That is a historic contraction. We're talking about the sharpest immediate supply destruction we have seen in modern economic history, honestly rivaling the absolute worst moments of the 1970s oil embargoes.
By the way, if you rely on this kind of direct, no-nonsense, data-driven analysis to understand what's actually happening in the real economy, hit that subscribe button right now. We constantly monitor these critical data points behind the scenes so you don't have to.
Now here's the really crucial point. This crisis doesn't just stop at the gas pump. The supply chain casualties are spreading like wildfire right now. We're seeing severe disruptions in global agriculture because fertilizer costs are skyrocketing. Aluminum production is being heavily curtailed because, well, it's incredibly energy intensive to produce. Even critical helium supplies, which, by the way, are absolutely vital for things like medical imaging and semiconductor manufacturing, have been massively depleted by this regional conflict. The entire industrial base is taking a massive hit across the board.
Section 3. Central banks diverge drastically. Welcome to the Great Divergence.
We're looking at a monetary landscape right now that is completely fractured. On one hand, you've got the U.S. Federal Reserve maintaining a pretty restrictive stance, basically struggling in this tug-of-war to balance sticky inflation against a slowing labor market. Then, you've got the European Central Bank trapped in a structural hold, totally paralyzed by weak domestic growth and external energy shocks. And then, there's the Bank of Japan, which is aggressively accelerating its tightening cycle, actually moving its target rate to 1.0%. The era of synchronized global central banking? Yeah, that's completely dead.
The situation playing out in Japan is particularly fascinating. In an incredibly rare move, the Bank of Japan's board suffered a historic fracture. They voted 6-3 to hold rates at 0.75% in April. But look at what they did at the exact same time. They sharply upgraded their core inflation outlook for fiscal 2026 to 2.8%. They're openly admitting that inflation is running hot, and it's being driven by the collapsed yen and that massive surge in imported crude oil costs we just talked about.
As the Bank of Singapore reported, 3 of those 9 board members actually dissented and voted for an immediate rate hike. Why? Because higher crude prices are directly eating away at Japanese real income. Despite their domestic growth being incredibly sluggish, we're talking just 0.6%, the hawkish pressure to combat stagflation is becoming impossible for them to ignore. They're basically being forced to tighten monetary policy right into the teeth of an economic slowdown, just to defend their currency.
Section 4. The K-shaped economy.
So this brings us back to the big question. How on earth can we have Goldman Sachs projecting sturdy GDP growth while JP Morgan is sounding the alarm with a 35% recession risk? Well, the secret behind these completely conflicting macroeconomic numbers is a K-shaped slowdown. It's a totally fragmented economic reality. The top arm of the K represents high-income earners, capital-intensive industries and tech firms, and guess what? They're thriving. But that bottom arm of the K represents the bottom 60% of the economy, and they are suffering immensely right now from sticky inflation, rising energy costs, and massive crushing debt burdens. Those sturdy top-line GDP numbers, they are simply obscuring the very real, painful erosion of purchasing power for everyone else.
The contrast here is just stark. On one side, we have this incredible technology-driven productivity boom. An AI supercycle and quiet liquidity injections from central banks are propelling asset prices to absolute record highs. From that angle, it looks like an incredible economic boom. But look at the other side. Look at the harsh reality at the bottom of the K. We're seeing jobless growth where AI reduces labor needs, soaring debt service costs, and private credit defaults rapidly approaching 5%. The vulnerable are literally being crushed, while the overall aggregates look fine and sturdy. And that right there is exactly why JP Morgan's recession risk is sitting at 35%. The foundation underneath it all is entirely hollow.
Now, if you really want to understand exactly how the top half of this K-shaped economy is operating right now, you need to see how this AI supercycle is warping global capital flows. Click the explainer on your screen right now to binge-watch our complete, deep-dive analysis into the 2026 AI boom, and I will see you over there.